Welcome to AG John Show. What you're witnessing in silver right now is not a market losing control. It's a system revealing how much control it believes it still has, and that distinction matters more than any price level you see on a chart. Silver has crossed into political territory because it exposes pressure points that currencies, bonds, and even equities are designed to hide. And when those pressure points become visible, volatility is not an accident, it's a response. For years, silver was dismissed as too small to matter geopolitically, too volatile to be strategic, and too industrial to be monetary. But that misunderstanding is exactly why it has become so powerful at this moment. Silver sits at the intersection of energy, technology, inflation, and trust. And whenever multiple systems converge on a single asset, price stops being a number and starts becoming a message. The United States and China understand this dynamic far better than the average investor, which is why their behavior around silver looks confusing if you assume free markets and logical price discovery still dominate the process. What's actually happening is a contest over narrative control, because whoever controls the perceived value of silver influences how the world interprets inflation, scarcity, and monetary credibility. In the US-led financial system, stability is the priority signal, and stable prices imply effective policy, contained inflation, and confidence in institutions, even if that stability requires heavy reliance on derivatives and leverage. In contrast, China prioritizes resilience over optics, focusing less on daily price movement and more on long-term access, physical control, and insulation from external financial pressure. This difference in strategy creates a fault line, and silver trades directly on that fault line. When silver prices fall sharply despite rising industrial demand and constrained mine supply, the move isn't explaining reality, it's managing perception. When silver rebounds violently with little warning, the move isn't speculative enthusiasm, it's pressure leaking through a structure that was never designed to hold it indefinitely. Volatility is the visible symptom of an invisible struggle. A true price war isn't about destroying value, it's about shaping expectations, because expectations determine behavior, and behavior determines outcomes. If investors believe silver is unreliable, unstable, or permanently suppressed, they disengage, which reduces immediate pressure on the system. If investors believe silver is strategically important and undervalued, they accumulate, which tightens supply and accelerates repricing. Managing that balance is why silver is allowed to move, but not too far, and why it's pushed down, but never permanently eliminated. The US benefits from keeping silver volatile and untrusted because volatility discourages its use as a monetary signal, reinforcing the dominance of dollar-based assets. China benefits from volatility as well because suppressed prices allow accumulation without drawing attention. While sudden spikes test the limits of Western control mechanisms, both sides are playing the same board, but with completely different objectives. This is why traditional explanations fail. You'll hear analysts talk about interest rates, employment data, or speculative positioning, and while those factors matter on the surface, they are not the drivers, they are the tools. The driver is strategic positioning in a world where financial power is increasingly weaponized. Silver is uniquely sensitive to this because it cannot be created digitally, cannot be substituted easily at scale, and cannot be printed to solve shortages. Every ounce exists in the physical world, and every ounce diverted into long-term storage reduces future flexibility. That's why industrial demand matters more than headlines suggest. Solar panels, electronics, grid infrastructure, and defense applications consume silver steadily, predictably, and irreversibly. Unlike gold, which is hoarded and recycled, silver is often lost, dispersed, or locked into products that won't return to the market for decades. This makes sustained mispricing dangerous. A system can suppress perception, but it cannot suppress physics. China understands this, which is why its approach to silver mirrors, its approach to rare earths, energy security, and supply chains accumulate quietly, diversify settlement options, and avoid public confrontation until leverage is secured. The US understands this too, but operates under different constraints. Its system depends on liquidity, confidence, and global participation, which means overt accumulation or admission of scarcity would undermine the very structure it relies on. So instead, price becomes the pressure valve. Paper markets expand, leverage increases, and volatility absorbs stress that would otherwise manifest as a sustained upward repricing. This works as long as physical delivery remains secondary. The moment physical demand overwhelms paper supply, the strategy breaks. That's why delivery stress, inventory drawdowns, and regional premium discrepancies matter more than daily spot prices. They are the early warning signals. When Asian markets consistently pay more for physical silver than Western benchmarks imply, that gap is not arbitrage inefficiency, it's a credibility gap. It tells you where trust resides and where it's fading. Silver turning political means it is no longer allowed to speak honestly through price, so it speaks through behavior instead. It speaks through shortages that don't make headlines, through industrial users locking in long-term contracts, and through governments adjusting stockpiles without announcement. Markets tend to ignore these signals until they can't. Another layer of this conflict is currency credibility. Silver doesn't just compete with gold as a store of value, it competes indirectly with fiat systems by highlighting their dependence on confidence. When silver prices rise alongside inflation, it confirms what consumers already feel but policymakers want to deny. That's why silver spikes are often met with disproportionate responses. They challenge the narrative that inflation is temporary, manageable, or purely cyclical. In a world where trust is thinning, narratives matter. China's long-term strategy relies on a gradual transition away from dollar dependence, not a sudden rupture. Silver helps facilitate that transition by offering a tangible, globally recognized asset that supports industrial growth while hedging monetary risk. The US, meanwhile, must prevent silver from becoming a symbol of monetary doubt. So instead of outright suppression, the approach is controlled instability. Let silver move, but make it unpredictable. Let it rally, but ensure it crashes. Confuse participants, fragment conviction, and keep positioning short-term. Volatility achieves all of this. The irony is that this very strategy plants the seeds of its own failure. Every violent move trains market participants to expect bigger moves. Every suppression attempt increases the payoff of being early rather than late. Every period of artificial calm increases the shock when reality asserts itself. This is why silver cycles feel increasingly compressed. Moves that once took years now happen in months. Corrections that once took months now happen in days. The system is accelerating. Political assets always accelerate before they resolve, because pressure builds faster than trust can be rebuilt. Silver is no longer being priced solely by miners, refiners, and jewelers. It's being priced by strategists, policymakers, and institutions thinking in decades, not quarters. That's why the volatility feels disproportionate to the news. The news is irrelevant compared to the positioning. What matters is who needs silver cheap, who needs it available, and who needs it ignored. As long as those needs conflict, price will remain unstable. The key mistake most observers make is assuming this instability signals failure. In reality, it signals importance. Markets don't expend energy controlling assets that don't matter. They don't tolerate complexity around things that are irrelevant. Silver is volatile because it matters again. And once an asset matters politically, it never fully goes back to being just a commodity. The question is not whether silver will stabilize. The question is whose terms that stability will be built on. Because stability achieved through abundance is very different from stability enforced through control. And right now, the market is still pretending those two outcomes look the same. What most participants fail to grasp is that markets do not transition because everyone agrees. They transition because disagreement becomes too costly to ignore. Silver has entered that phase where disagreement between paper representation and physical reality is no longer abstract, it is operational. Operational stress changes behavior faster than ideology ever could. When delivery timelines stretch, when premiums persist, and when contracts settle differently across regions, participants stop debating theory and start securing outcomes. This is where the conversation quietly shifts from price to access. Price can be hedged, access cannot. Institutions that require silver for production do not care about weekly volatility if supply is guaranteed. Their primary risk is interruption, not valuation. This is why long-term procurement contracts are being prioritized over spot exposure. It is also why these arrangements rarely appear in speculative data. Speculators watch charts, strategists watch logistics. Those two perspectives only align during crises. As logistics tighten, the market's tolerance for abstraction declines. Every synthetic ounce becomes suspect when physical fulfillment becomes uncertain. This creates a hierarchy of claims. Direct ownership outranks allocated storage, which outranks unallocated promises, which outrank derivatives entirely. Hierarchy matters only when systems are stressed. In calm periods, everything appears interchangeable. Silver's volatility is a signal that interchangeability is breaking down. Not everywhere at once, but enough to matter. When claims stratify, confidence fragments. Fragmented confidence expresses itself as price instability. This instability is not random. It clusters around moments when control mechanisms are tested. Margin hikes, settlement rule changes, and reporting anomalies are not coincidences in such environments. They are responses to stress that cannot be resolved quietly. Each response buys time but increases awareness. Awareness is the enemy of managed perception. And once participants begin questioning the integrity of signals, they demand redundancy. Redundancy favors physical assets. This does not require mass participation to matter. It only requires enough participants to overwhelm marginal supply. Marginal supply is always thinner than it appears, especially in markets where most volume is synthetic. Silver's paper volume dwarfs its physical throughput. That imbalance is sustainable only while confidence holds. Confidence, once lost, does not return symmetrically. It requires stronger evidence to rebuild than it did to disappear. This asymmetry explains why control becomes progressively more expensive. Each intervention must be larger than the last to achieve the same effect. Larger interventions are more visible. Visibility accelerates skepticism. Skepticism alters behavior. Altered behavior alters market structure. Market structure, once altered, cannot be reversed easily. It embeds new incentives and new expectations. Silver's structure is changing beneath the surface. The volatility you see is the shadow of that change. This is why attempts to explain silver through single variables feel inadequate. The system is no longer single variable. Interest rates, inflation data, and employment reports are inputs, not drivers. They influence timing, not direction. Direction is being set by strategic necessity. Strategic necessity is immune to short-term pricing. Nations do not abandon infrastructure plans because metals become inconvenient. They absorb cost or seek alternative arrangements. Those alternatives often bypass open markets. They move through bilateral agreements and off-exchange channels. Each bypass reduces transparency. Reduced transparency increases uncertainty. Uncertainty increases volatility. The cycle reinforces itself. This self-reinforcing loop is characteristic of politicized assets. Gold has lived in this loop for decades. Silver is entering it now, but under different conditions. Its industrial role makes suppression riskier. Unlike gold, silver scarcity disrupts production. Disrupted production carries political consequences. Political consequences force attention. Attention invites scrutiny. Scrutiny weakens narrative control. Weak narratives require stronger enforcement. Enforcement, when financial, manifests as volatility. Volatility becomes the visible mechanism of discipline. But discipline only works while participants believe it is rational. When it appears desperate, it loses effectiveness. Desperation is sensed, not announced. Markets feel it before they articulate it. That feeling is what traders describe as disorderly action. It is the intuition that something is off. Disorderly action is not failure, it is friction. Friction emerges when systems resist necessary change. Resistance delays resolution, but amplifies impact. The longer the delay, the sharper the release. This is why silver's moves feel outsized relative to news. The news is merely the spark. The fuel is accumulated imbalance. Fuel does not care about narratives. Eventually, imbalance expresses itself through repricing. Repricing is not negotiation. It is correction. Corrections are rarely polite. They arrive when tolerance is exhausted. Tolerance in silver markets is eroding because flexibility is gone. Supply is rigid, demand is policy-driven, and confidence is conditional. These are not the ingredients of stability. They are the ingredients of transition. Transitions always look chaotic from within. Only in hindsight do they appear inevitable. Silver is not forecasting the future. It is reflecting the present more honestly than most assets are allowed to. That honesty is uncomfortable. Uncomfortable signals are often dismissed first. Dismissal buys time but deepens misalignment. Misalignment compounds risk. Risk does not disappear when ignored. It migrates. In silver's case, it migrates into volatility. Volatility becomes the messenger. You can shoot the messenger, but the message persists. Markets eventually internalize what volatility is saying. What silver is saying now is simple but inconvenient. Control is expensive, scarcity is real, and trust is thinning. Those realities do not require belief to operate. They require only time. Time is the variable. No system can hedge indefinitely. Silver's behavior suggests that time is no longer abundant, and when time becomes scarce, price eventually stops pretending. Another element quietly reshaping silver's role is how risk is being redefined across financial systems. Risk is no longer just volatility, it is dependency. Assets that rely on uninterrupted trust chains now carry hidden fragility. Silver reduces dependency because it settles in the physical world. This matters more as systems fragment. Fragmentation rewards assets that function without permission. Permission-based systems work best in cooperative environments. They struggle when incentives diverge. Silver does not require alignment to exist. It only requires extraction, refinement, and custody. That simplicity is its strength. It bypasses layers where leverage accumulates. As leverage expands elsewhere, contrast sharpens. Silver begins to stand out not by promise, but by absence of promise. Absence of promise reduces disappointment. Disappointment is what destabilizes trust. Trust once broken does not reset automatically. It demands proof, not reassurance. Proof in markets comes through delivery. Delivery is where silver exerts pressure. Paper claims can roll indefinitely. Physical obligations cannot. This creates stress points that charts cannot fully capture. Stress leaks through volatility. Volatility is often dismissed as speculation. In reality, it is negotiation. Negotiation between what is claimed and what is available. Between what is promised and what can be delivered. As long as negotiation continues, instability persists. Resolution only comes when one side yields. Yielding can take different forms. Supply expansion, demand rationing, or structural repricing. Supply expansion remains constrained. Demand rationing is politically sensitive. That leaves repricing as the eventual outcome. Repricing is uncomfortable but clarifying. Clarity forces adaptation. Adaptation reshapes portfolios and policies. This is why silver volatility attracts institutional attention quietly. They watch behavior, not commentary. Behavior indicates pressure before it becomes visible. Pressure determines timing. Timing is the only uncertainty. Direction is increasingly clear. Clear direction does not imply smooth movement. It implies contested movement. Contested movement is volatile by nature. Volatility is the cost of disagreement. Disagreement over value intensifies when stakes rise. The stakes around silver are rising. Energy systems, technology chains, and defense planning all intersect here. Intersection multiplies importance. Importance invites oversight. Oversight invites intervention. Intervention reshapes markets temporarily. Reality reshapes them permanently. Permanent reshaping takes time. Time favors physical constraints. Physical constraints do not negotiate, they assert. Silver asserts through availability. Availability is the ultimate signal. When availability tightens, narratives weaken. When narratives weaken, confidence shifts. Confidence shifts. Change flows. Flows determine outcomes. This sequence has played out before in different forms. It is playing out again under new conditions. The difference now is speed. Everything moves faster. Faster cycles compress learning. Compressed learning accelerates positioning. Positioning precedes price. Price follows behavior. Watching price alone misses the point. Watching behavior reveals intent. Intent is what matters in politicized assets. Silver has entered that category. Once there, it does not revert quietly. It remains contested. Contested assets redefine risk management. They force longer horizons. Longer horizons favor patience. Patience favors ownership. Ownership reduces float. Reduced float amplifies moves. Amplified moves reinforce awareness. Awareness spreads faster than explanations. At that stage, control loses subtlety. Blunt tools replace finesse. Blunt tools are visible. Visibility undermines credibility. Credibility, once questioned, demands resolution. Resolution arrives through repricing. That repricing does not announce itself. It arrives amid volatility. Volatility is not the end state. It is the transition state. Silver is living in transition. Transitions are uncomfortable but necessary. If you want to understand how stressed the system truly is, watch silver's behavior closely. It is telling you more than official narratives ever will. If this breakdown added clarity, like the video so more people can see beyond surface-level explanations, subscribe for deeper no-noise analysis on markets, power, and money, because this story is far from over.